Today we are focusing on Tax 1501. We will be covering studying Learning Unit 1 and Learning Unit 2, and then we're going to have a little question at the end of the session so that we'll test our understanding as to whether we were listening to the theory that we had in the class. Okay. Just a moment. There we go. Right. Our introduction would go as follows. It's we're dealing with tax, which is a reality most South Africans are faced with, whether they are earning a salary or running their own businesses, with most of the transactions activities that are subjected to some form of a tax. So what they're saying here simply is, if you are actually employed, for some reason you will be able to pay the tax if you do meet the requirements. If you are actually running a business as well, so you need to register for income tax or the VAT, so that you will be able to do your submissions in regards to the taxation. So in the example here, it says that if you earn a salary, I think I have explained that, or you pay the income tax on the salary and at the end of each month, provided that your salary is above the tax threshold, meaning that when you meet up with the requirements of you paying the tax. And if you buy goods, you normally pay what's called the value added tax, that's VAT. We are currently at 15% on that one. So when you're buying goods, this affects most of the people, because when you go to the store, whether you're a kid, whether you are an adult, you will be able to pay some form of a value-added tax depending on what type of goods are you purchasing. Some of the goods are actually what are exempted from tax, and some are actually zero rated towards your value-added tax. In addition to that, if you are required to register as a taxpayer, you may require to submit an annual income tax return. Clearly, the tax has an impact on everybody's life, and as a result, it is important for taxpayers to have an understanding of the overall tax system, as well as having the ability to calculate how much of the tax they owe or it's due to them. All right. The second part deals with the national budget that is actually set up by the government, income and expenditure. Right. So this whole entire system in regards to the tax starts with the Treasury Department. SARS is only administering what has been established by the National Treasury. Yeah. Usually we know that the minister may make some announcement with regards to the changes pertaining to tax. Right, the fiscal year is 12 months period ending on the 31st of March every year. Okay, so the fiscal year is more like the financial year end period. So, but in accounting we call it the financial year end period, and in tax we call it the fiscal year. So each year in February, the minister announced on what the government will spend the money for the next 3 years, and where the money has to pay these expenses will come from. Basically, it will come from us as the individuals. Right, and the minister also announced how much of the income tax individuals and other entities will pay during the next year of assessment in order to balance the government budget. Right, so basically what happened is, if for example like the VAT increases, is the minister of Treasury Department's responsibility. It has nothing to do with SARS. SARS, they will just actually welcome whatever the adjustment that they make, and they will go forward with that. The majority of the state income is derived from the tax, although nearly a third of the total revenue from the national government tax come from the indirect taxes, such as, I think I was supposed to say, such as value-added tax. All right, so usually we all get tax as we are working. The reason behind that is just for the provision of the infrastructure. So like, if we cannot afford our healthcare, government will be able to rescue us. So it could be the roads, it could be the lights on the streets, it could be so many things that are actually covered by what's called tax. So that's the whole reason, or the whole idea in regards to the paying of tax. So the government fiscal year is actually different from an individual tax of assessment. The year of assessment for an individual begins on the 1st of March and it ends in between the 28th and the 29th of February each year. So with the government is actually on the 31st of March. For a company's year of assessment is actually the same as the company's financial year, depending on when are you starting as your company. February, it can be January, it can be March, it can be February, it can be whatever the month in the year. Right. In regards to how the tax brackets work, you need to actually refer to the diagram in your study guide. I think it's somewhere on page 22, if I'm not mistaken. You will just check as to if you are earning so much, and then how much are you supposed to pay based on the tax brackets. It is also important to point out that you're not expected to be able to recite the sections of the Act in this module. Basically, what they're saying is, remember in tax, we're dealing with what's called the sections, the legislations, or the Act. So when you're actually at a far level of your studies, probably on third year, that's where you will be able to say Act so and so and so. It's actually dealing with this kind of a transaction. All right, I know it's popularly known when you are actually doing your fourth year, which is your honors or postgrad level. Let's look at or account for what SARS do. It is the revenue service collecting tax agencies of the South African government. They work on behalf of the Treasury, and it was established by the legislation to collect the revenue and ensure compliance with the Income Tax Act, meaning that they cannot just charge you because they want to charge you. They have to comply with the Income Tax Act in order for them to actually charge you. Its vision is to be innovative revenue, or is to innovate revenue and customs agency that enhance economic growth and social development and support South African integration into the global economy in a way that benefits the citizens. So you benefit by being covered by the government for some certain things. As I said, like going to the hospital or the roads or whatever the lights it might be, or the parks and all of those. So usually you indirectly pay for that one. You pay SARS and SARS take care of that. Or the social grants. So the money usually it comes out of the SARS. So 350, it may be coming out of that. So in accordance with the South African Revenue Service Act 34th, 1997, the service is administratively autonomous organ of the state, which it is outside of the public service but within the public administration. Okay, so basically that's what I just explained. So they deal with the administration of what the National Treasury has implemented. Even though South Africa's tax regime is set by the National Treasury, it is managed by SARS. I have explained that. SARS aims to provide an enhanced, transparent, and client-oriented service to ensure optimum and equitable collection of the revenue. Okay, so Treasury implement that, SARS collect on behalf of the government. Okay. Let's look at their main functions there. They collect and administer the national tax, duties, and the levies. They collect the revenue that may be imposed under the legislation as agreed on between the SARS and the government. They provide protection against the illegal importation and the exportation of goods. And they facilitate trade. They advise the Minister of Finance on all the revenue. Okay, collect and administer your normal taxes and duties. That's what we are actually paying. They collect and administer that. They collect the revenue that may be imposed under the legislation. Obviously, there should be a compliance there, as agreed in between the SARS and government, which is the National Treasury. And they provide protection against the illegal importation and exportation of goods. Okay, so usually the bulletin number 3, it's just there to protect actually the local businesses. That's why they just can't go against it, but they don't really encourage people to actually buy abroad. Right. So that's why normally when you go to the airport, you would see these police people that they're wearing their police uniform, but it's written import or export, SARS, something like that. So those people, they are actually given protection with regards to this importation or the exportation. The main issue, the main concern there is, are you complying? Are you paying your export or importation tax? Right? And they also facilitate trade in terms of the business, or they facilitate trade in terms of their services. Right? They also administer, you minister on all the revenue matters. But let's highlight some of the most common taxes SARS is responsible for. Income tax. Income tax is a tax that is imposed on individuals or entities. Those are the taxpayers in terms of the Income Tax Act 58 of 1962. That varies with the respective income or taxable. So you can all see that this thing called the income tax has been in existence for quite a while, right? So that's actually abided by the Income Tax Act 58 of 1962. Income tax generally is computed as the product of tax rate multiplied by the taxable income. So this is where the table is going to come into the picture for you. All right. So the examples of the amounts individually you may receive and from which the taxable income is determined is included. Okay. So number two, the first one is actually your income tax. Right, let's see where that income tax is based on. They're looking at the remunerations, income from the employment, such as salaries, your wages, your bonuses, overtime, taxable fringe benefits, allowance, and certain lump sum. Right, basically that is based on the income that you get as an individual taxpayer. It may be the bonus, excuse me, it may be the bonus, it might be the overtime that you pay, or the fringe benefit. Fringe benefit, we're going to deal with it. I think is on Learning Unit 6, if I'm not mistaken. It's an independent learning unit that we are actually going to deal with it. It simply deals with when an employee is actually receiving a certain benefit that is substantiated by the employer, meaning that the employee is going to receive a certain income added together by a certain percentage with your employer. Okay, so you go to, it's actually going to be you and the employer contributing towards that. But like I said, we'll see that when we cross the bridge in Learning Unit 6 or 7, but somewhere there. Profit or losses from the business or trade. So when you're in a business and you're making a profit, eventually, my apologies. When you are in a business of trade, when you make a profit, obviously there's a tax that you are actually going to pay. I heard on the news that last year they took it out from 28% to 27%. Okay, so for whatever the trade that you have, we know that most of the businesses are actually not registered, but just to ensure that the compliance has been met, you just need to register that and submit your returns. The incomes or profit arising from the individual being a beneficiary of the trust, so the trust will be taxed as well, not part of this content. The director's fees also not actually part of this content. Investment income, it is actually definitely part of us, such as an interest and foreign dividends. There's a small portion with regards to the interest along with your foreign dividends. I think we're going to deal with that on Learning Unit 3 or 4. Rental income or losses when you're renting out the apartments. Obviously, when people are making the payment, it's going to be received as an income. It has to be part of the taxes as well. Your incomes from your royalties that would be taxed as well. We don't have much of that in this content. We don't have much of the annuity as well. Pension income we do have, and we are going to have capital gains tax. Okay, so capital gain tax is also an independent content. I think is the last learning unit, which is probably 7. So we're going to deal with that when we actually cross it. Now I'm just giving you a hint on the type of text that we are or will be coming across as part of our content. But there are tax brackets on page 22 of the study guide. I think one of the questions would require us to actually go back and revisit as to how is that actually structured. Okay, so we'll see that when we do the question by the end of this session. Well, let's have a look at the capital gains tax, CGT. I have explained that. It says that it is definitely not a separate tax, but form part of the income tax, and it arises when one disposes an asset on or after the 1st of October 2001 for the proceeds that exceeds the base cost. So one of the elements that you're going to look for is when you do the CGT, which is capital gains tax, you're going to have what's called the proceeds, and then you're going to look at the base cost, and then we're going to have the difference into that one, and then that's how we're going to launch or invite the CGT. Last time I checked, it was actually at 40 or 45%, but Learning Unit 7 will actually tell us that. Donation tax, we do have that, definitely. So donation tax is any free or at no charge disposal of the property if the person or the donee received the donation gives anything that's actually in return specifically for that donation. Donation tax is levied at the rate of 20% of the agreed value of property donated exceeding 30 million rand and at a rate of 25% on the value exceeding 30 million rands. Okay, so here it is talking about the specific donations in terms of the property. I'm not sure if that actually makes sense, but at this point in time, we're not going to deal with this kind of a donation. There is going to be a donation tax that's levied at 10%, but it's not based on the property. Right, the person making the donation, the donor, is liable to pay the donation tax. However, if the donor fails to pay the tax within the payment period, the donor and the donee are jointly and severally liable for the tax or donation tax is imposed by the Income Tax Act. Okay, so if you donate the property that worth about 30 million or that exceeds 30 million rands, obviously there's going to be a rate in regards to that. And then should the donor fail or the donee fail to pay the donation tax, they are jointly, meaning that they're all going to be jointly and severally liable for that donation. They just have to discuss as to how they're going to pay it. Okay. Obviously, there's going to be an agreement signed when you make a donation. And at a tax, the last year when we were doing tax, this part was actually not part of the content. It came in at some point, but they took it out for some reasons I don't know. All right. But the value-added tax is commonly known as VAT, and it is imposed by the value-added tax of 89 of 1991. It has been in the picture for quite a while as well. Right. We call the VAT an indirect tax. Be careful on your multiple choice question on the consumption or the usage of goods and services in the economy. So you might have one of the questions based on your VAT. Make sure that you do understand exactly. Right, or you might have a question in regards to your, especially on your assignment number 1, donation tax. Right, VAT has increased from it used to when I joined this class, it was 14%, and it's now 15% from the 1st of April 2018. And VAT is levied on the supply of most goods and services and on the importation of goods. Some goods and services are actually not that attractive. They are actually at a 0 rate, or they are actually exempt from tax. Like I said before, just be careful of those list of goods that are 0 rated and those list of goods that are actually exempted from VAT. Right, so that's actually in a nutshell in regards to the VAT. We'll move on to the next one now with customs duty. Like as I said, it's actually, this one is imposed by the Customs and the Excise Act of 91 of 1964. Don't worry about this act. They're not going to apply it anyhow. And they're levied on the imported goods with the aim of raising revenue and the protection of the local market. I have actually explained that, but we don't have a specific content in regards to the customs duty. However, you might have that little piece in terms of your assignment regarding the customs duty. So it further means that if a product can be bought from outside of the South Africa for less than in South Africa, the customs duty raise will encourage the person to rather buy locally, just to avoid the customs duty. I think it will be advisable for me as well to can buy locally. Dividends tax, as I said, we've got a little piece with regards to the dividends tax. It is a tax on the shareholders or beneficial owners when the dividends are actually paid out to them. Right, so they get to be taxed. It's going to be treated differently. It's up there in one of the learning units as well, but that does not belong to you. That does not belong to me. That belongs to the business owners, or what's called the shareholders. Right, so those are the people that are going to receive the dividends, and they are actually going to be taxed on that. Right, remember we've got what's called the local dividends and the foreign dividends. The treatment is going to be different as well, but I will make sure that I do summarize that easily for you. Right, a dividend is in essence any payment by a company to a shareholder for a share held in the company. Right, so shareholders are actually, they own the rights, the equity right called shares. All right, so they are actually in a form of a percentage. It will be me, it will be Anzani, it will be Catherine, and so forth. We run a company, and then we all hold our different interest in terms of the percentage. That's called a share. All right. So dividend tax is payable by the beneficial owner of the dividend, but is within the dividend payment and paid to SARS by the company at a rate of 20%. It's going to be different when we get there. All right, so there's going to be some adjustments in terms of how you're going to treat the dividends, depending on whether it's a local or whether it's a foreign. So the dividend tax is part of the income tax 58 of 1962. Like I said before, please do not worry about the act. Excise duty, which is imposed by the Customs and Excise Duty of 91 and of 1964. There's nothing more there. Right, you may have a multiple choice question that name, or maybe they give you a list of the types of tax. They give you the correct one and the incorrect one that are suitable for this content, perhaps, and then where you have to advise as to whether they are relevant or they are actually not relevant. Transfer duty, which is a tax that is levied on the value of the property acquired by an individual. The transfer duty rate is determined by the value of property. Right, so usually when you're given something like this, which is actually not even part of this content, but if you're given something like this, because we don't have what's called a specific rate on the transfer duty, so usually they will tell you how much you have to use as a percentage when you're calculating your transfer duty. It is well imposed by the Transfer Duty Act 40 of 1949. The estate duty is payable to an estate of every person who dies and whose net estate is in excess of 3.5 million. So basically, when you die, your estate duty is less than 3.5 million rand, that means you're not going to be able to pay your estate duty, but you will be able to pay that should it be in excess of 3.5 rand. Right, the estate duty is imposed by the Estate Duty Act of 45 of 1995. Okay, I thought I was confusing it with the transfer duty, but that's fine. Right, it is actually levied on the property of residents and the South African property of non-residents deduct or less the allowable deductions. It is actually charged at a rate of 20%. Right, so that's actually if it's an excess of 3.5 million rand. Skills Development Levy. How many of you have heard of this Skills Development Levy, SDL? It's a levy that has been imposed to encourage learning and development in South Africa and is determined by the employer's salary bill. Remember these courses that you do normally have where they say you're going to be off for 2 weeks and stuff like that. So that's actually called a Skills Development Levy. Apparently, there's a levy tax based on that one. I wasn't aware of that. And the funds are used to be used to develop and improve the skills of the employee. The Skills Development Levy is imposed by the Skills Development Levies Act 9 of 1999. UIF, I've been a victim of this. It's called the Unemployment Insurance Fund. You know that it normally occurs when you lose your job or when you go to the maternity and stuff like that. But let's hear what it does. What does it say? It gives a short-term relief for workers when they become unemployed or when they're unable to work because of maternity or the adoption leave or some sort of an illness. It also provides relief to the dependents of the deceased contributor. Say you die while you are working and paying your 1% towards the SARS. You should be able, your family or your dependents should be able to get that money back. They can claim it on your behalf. I know about this one because I know of somebody who actually claimed that 1% when somebody that I know dies. But all employees as well as their employers are responsible for the contributions towards the UIF. I know it's usually 1% for each. So when the employer and the employee are actually paying concurrently, it means that, if you remember what I said about the fringe benefit term. So when the employer is paying, it can be UIF, it can be a pension fund, it can be medical aid, it can be the rest, it can be some other things, as long as they are actually paying on your behalf as well. That results to a term called the fringe benefits. The Unemployment Insurance Fund is imposed by the Unemployment Insurance Contribution Act 4 of 2002. Okay, I think maybe they've realized that most of the employees, they suffer when they lose their employment because they cannot sustain their life for whatever the months that they have been employed for. Okay, before I get to 1.2, let me just come back to you and then let's hear if you guys have got a problem. Is there anybody who's got a question? Anybody with a question quickly? All right, thank you. It means I can move on. So we're going to look at the basis for the taxation and the types of taxation. Okay, let me just scroll down. All right, South African residents are taxed on the residence basis, which means that they are taxed on all the income they earn in South Africa as well as on their nationwide. As long as you're earning an income in South Africa, there should be, or there's a chance that you would be taxed. Even if you get your income internationally, as long as it's actually landing in a country, you have to comply with the method of being taxed. That's a rule. Non-residents are taxed on income from the sources within South Africa. So you can't tax the non-residents if, let's say, they're in Burundi or they're in America and they're earning an income aside. But the moment they get the income from South Africa, they are going to be taxed. Please do not confuse the two. Right, the South African government has entered into what's called the tax treaties. It's a double tax agreement with various countries to prevent some income from being taxed in both countries, as this will be unfair towards the taxpayers. Of course, it is going to be unfair. Imagine you are in the United States, you earn an income in South Africa, we tax you, and then when you get there with your net, they also do tax you. That's why it's important for a country to get into what's called the double tax agreement with many parts of the world. Right, should the same income be taxed in both countries, a credit would normally be allowed in the country of residence for the tax paid in the other country. Should there be an error in terms of double taxing you as a foreigner, the chances are, or you will be able to get a credit based on the country where you are. If South Africa has taxed you and the America has taxed you, they must give you that money back. Unfortunately, you just have to wait for that filing season to come in that specific country. But a tax treaty is an international agreement, also called a double tax agreement, aimed at eliminating or providing a relief from the international double taxation. Otherwise, there's no need for people to actually make international deals because you're going to have a problem if you're getting double taxed. Let's look at the different tax that the government levies and that SARS administer can be grouped in a different way based on who is responsible for paying the tax. That has been a big question for many years, but we all know that we, or you and I, are responsible for paying tax. What are the methods used to calculate the tax? Obviously, they do differ based on the tax brackets, or whether it's a VAT, or whether it's an estate duty, or whether it's a company tax, and all of those. The grounds on which the tax are actually levied. What are the sources that are actually using in levying the tax for you? All right, moving to 1.3, where it says the interpretation of the tax law and the legal remedies. Not everybody is actually happy with regards to the outcome of the tax submission. But most of us, even if we're not happy, what we do is we always say it's okay. I will see it in the next filing season. However, if you are not happy with your submission, this is the part where you need to observe quite extensively. Right, when applying for the tax law, there are normally two ways of looking at the wording of the section. Firstly, SARS has the responsibility to levy tax as set out in the Act, and therefore the wording of the section will be interpreted in order to levy the tax, while, on the other hand, the taxpayer does not want to pay tax. Therefore, he wants to read the wording in order to ensure that he does not actually pay any tax. All right. Unfortunately, if you are in this country and you are employment, or you are actually doing certain types of businesses, you've got no choice but to pay tax or to comply with what SARS say. However, what happens if they overtax you, or what happens if they come up with their own stories to say that you have to pay tax for something that does not belong or does not match the standards of you paying tax? So that's where the interpretation of the tax law comes into the picture. So this may result in two different interpretations of the same wording, and to resolve these differences, a number of processes have been established throughout the year Let's look at the interpretation rules itself. That's actually in our second part, where SARS issue the interpretation rules setting out these rules that will apply for a specific section. Although these interpretation rules are not legislations, they're based on SARS legal opinion on how the applicable legislation should be interpreted. So the Commissioner can issue an advanced tax ruling or interpretations. The interpretation knows to resolve some of the confusion caused by the wording of the section. Right. So basically, they just tell you about the process in regards to your dispute. If you're not happy about the result that you get when they tax you from SARS, you can actually lodge a formal complaint with them so that they can really look into your financials. And then if you are still not happy, you can take them to different parts of the court section. Right, so the advanced tax ruling, which is called the ATR systems, works to promote clarity, consistency, and certainty about the interpretations, the applications of the applicable tax law. So in terms of the clarity and the certainty on the Commissioner's interpretation and applications of the tax law about the proposed transaction can be obtained through the binding public ruling. It's called the PBR, or the binding class ruling, which is called the BCR. Okay, guys, I'm going to ask you to actually go through your theory on this one, because I think some back in one of the semesters, I saw a question, multiple choice question based on these rulings or the interpretations of the ruling. Make sure that you do read that, because it might give you more marks to actually succeed to the next taxation. Interpretation notes are intended to provide the guidelines to stakeholders on the interpretations and the applications of the provision of the legislation administered by the Commissioner. So we've got the dispute resolution. That's the second process consisting of the legal procedure a taxpayer may follow if he or she disagrees with SARS regarding the assessment of the taxpayer. See, I have explained that before. Right, during this process, SARS and the taxpayer try to reach an agreement on what the interpretation should be. This process is called the dispute resolution. That's when you are arguing about the outcome that you get from SARS. Remember, when you do the submissions, so there's a form that you have to complete is called ITR 12, and then your results are coming into ITA 34 or IT 34, something like that. So looking at the importance of the ability of SARS to challenge the legality of actions and the decisions within the tax system is internationally recognized. Our system is actually internationally recognized. That's why we've got this thing all be acknowledged by the double tax agreement. We've got the right to appeal to be seen as please, hello, please be offline on that. Okay, you've got the right to appeal is seen as fundamental to the fairness of the tax system. An assessment IT, I spoke to this. I spoke to you about this. IT 34 issued by SARS and the taxpayer who does not agree with the assessment in which the taxpayer has been interested may object to that assessment. So you can actually object your results and say, I don't understand this. Obviously, you're going to follow what's called SARS internal processes. Well, the taxpayer can first request the reasons from SARS within 30 days of business from the date of the assessments. Once you get your ITA 34, in 30 days, they give you the right to actually request an objection. Okay. What the next one, it says that if the assessment contains errors, whether caused by SARS or the taxpayer, it is not necessary to object against the assessment. The taxpayer can just submit a request of correction. So if it's an error that has been made by you or that is made, you need to actually submit a correction of an error form to SARS and they can deal with that. So if the taxpayer disagrees with an assessment, the taxpayer may object to the assessment. The taxpayer must lodge its objection within 30 days after the following information has been submitted. So the date of the assessment is important. And then where taxpayer has requested reasons, the date of delivery of the notice where the SARS official has been satisfied the reason were provided for there. Objection must be made in the prescribed form. It's called ADR. I think SARS will just give you that, or if you go to their website, you will find it, or it's an NOO with an information requested in the form completed. And if the taxpayer is not satisfied with the outcome of the objection, the taxpayer may appeal, and the taxpayer can either use that alternative dispute resolution. Okay, so that will be the end of our learning unit 1. It was actually just theory. So when you've got theoretical questions based on the multiple choice, this is where you have to go. Right. So let's see who's got a question. Anzani. Jessica. Hi, Jessica. Jessica Mashamaide.
Good evening. How are you?
I'm fine. How are you?
I'm good, thank you.
Welcome back. Did you get your notes?
Yes. Sorry, I'm late. Yeah, but I'm very late today.
No problem. But did you get your accounting notes?
Yes, I did. Thank you so much.
You're welcome.
All right, thank you.
All right. Kalina, how happy are you so far? Kalina. All right, it means Kalina is still happy. Langanani, Paswana. Paswana. Hello, Paswana. All right, that's fine. Then it means everybody else is actually fine. And then we can move on to learning unit 2. Let me just find my learning unit 2 quickly for you. Hold on for me. Just want to get my learning unit 2. Right. So learning unit 2 deals with. Okay, I'm going to ask you guys if you can see learning unit 2 appearing on your screen.
Yes, I can on my side.
All right, thank you very much. It means everyone else can be able to see that. So learning unit 2, we're looking at you and I being employees and how are we going to be faced up with the income tax treatment. Our background goes as follows. We will be looking at the different steps followed by SARS in collecting a revenue tax for the year of assessment towards our salaried employees. Right. So when you earn a salary, the assumption will be you need to pay tax based on your gross. But that's actually not your responsibility. Your employer is actually doing the entire administration for you. What you do and being grateful for is to get your salary home. That's your net salary. So the employees usually earn or receive a pay slip from the employer which stipulates how much they earn and the deduction paid on their gross income. So basically, you get your salary before time, simply because if you're not happy, then you can just go to finance or HR and they can just fix up the matter. Your salaries advice, it would show the date on when your salary is going to reflect in your bank account, how much is going to be paid in your bank account, and the deductions. If you're a member of a pension fund, if you're a member of a medical aid, if you're a member of a UIF, if you're a member of, let's say, travel allowance and stuff like that. All of that information is going to be structured on your salary, including how much is going to be applicable to you. All right, and it's going to show, some it shows the employee number with the ID number, and some it just show the employee number only. All right, and then it's going to show that information, your name and then your initials, or your full name and surname would be there as well. That's how the salary is going to be structured. But it should be there in your study guide, just to have a look at it. Just to have a look at it. Unless, yeah, if you have your own salary advice from your employer, then I don't think that could be the purpose of the same thing. Income tax. Employees pay tax, which is called the pay as you earn, towards SARS via the employer as part of their deductions on a pay term agreement basis. So whether they pay you on a weekly basis or in 2 weeks, which is called fortnightly or monthly basis. The fact remains that if you do meet the requirements, the threshold, you should be able to pay tax towards SARS. Okay, so specifically the tax that you pay is called the pay as you earn. SARS provide the employer with a tax guide on a yearly basis indicating how much your tax should be or should the employee pay on their gross salary. So what they do is they send out the templates to all of these employers that they are registered on their database. And then obviously when they capture you on the system based on the level that you are as an employee, the system is just going to work itself. Immediately when they punch your gross income, it's going to split itself towards the UIF, towards the payee, towards the pension, towards the medical, and the remainder is going to fall down to show as your net salary. Okay, so most of you who are actually employed, I'm sure you guys have seen that. Pension or provident fund contributions, in most cases, permanent employees pays the above along their employers towards their contributions of organizations based on a certain percentage. So this is how it works. If your pension fund, let's say it's with GEPF, being a government employee, so what they do is they're going to charge you on a certain percentage and they're going to pay that on your behalf towards them. So the same thing applies to your UIF. It will go through to the SARS as well. However, the compensation of the Labor Department will be able to administer that should you lose your employment. If you are a subscriber in medical aid, maybe at Bonitas or life whatever, or Discovery and all of those, obviously they're going to, on your pay slip you will see how much has actually gone towards Discovery, but usually it will depend on who did you put as part of your medical aid or who are your dependents on the medical aid. So it varies in terms of our own individual contributions towards the medical company that we subscribe. UIF has been charged based on unemployment insurance fund contributions. All employees and employers are obliged to pay 1% towards the UIF contributions for the future to be covered for certain income should they lose their jobs, so be on maternity for a certain period, or contribution is made towards SARS or the UIF. It's conventional. Right, as I've explained, so if your employer is actually paying 1%, and you are also paying 1%, it's called a fringe benefit. So that will be able to rescue you when or in those rainy days when you are actually unemployed or when you are actually when you are on maternity, or if you die, your dependents will be able to administer or take that over. Okay, let's see, medical aid. Every employee who belongs to the medical aid must contribute a certain amount depending on how many members are covered. I think I have covered or explained that. Most often the employer contributes a certain portion for its employee as well. Should the employer pay on your behalf while you are actually paying as well, it's also called the fringe benefit. So usually is the issue of the percentage. They'll tell you we pay 60%, we can pay 40%, or we can go 50-50, or you can pay 60% and we'll be able to pay 40%. Depending on what the company structure looks like. All right, so there's going to be a deeper explanation that is quite tricky for each and every student on the medical aid. So today on the questions, we're not going to have the medical aid per se as part of the question. I've dedicated that for Saturday. So Saturday will be faced up with and 4. It's just a whole lot of theory on that one that deals with the deductions. And then we are going to, or I am specifically going to design a question for you based on the medical aid. And I'm not going to lie to you, it's going to be very tricky, it's going to be big, it's going to be very complex. The way it's so confusing is just going to be just like that. We're going to do a lot and more questions on medical aid because I know there is no way you can write an exam on your assignment without it. It's impossible. And they will always try and trigger you. Please be prepared when we meet on Saturday for that part. Okay, so there's going to be this comprehensive question with regards to the medical aid. Make sure that you are preparing yourself for Saturday. Membership fees. Employees who are subscribed to the certain organization like TO Garden Clubs pay may choose to pay their monthly fees from their salaries. All right, so yes, some employees, they've got what's called the organizations called the book club or the garden club or the cheat club. You see those kind of clubs. So they may choose with the employer to say on a monthly basis, please do deduct a certain amount that goes to the bank account of that club. Or else you've got options of maybe doing a debit order with your bank and they can just do that on a monthly basis. All right, or if you are belonging to a certain professional membership, let's say you are a SICA member, or you are an HPCSA member, or you are a certain member of a profession, if there's a payment that you have to make on a monthly basis or quarterly basis or yearly basis, you can still choose that kind of an option to say they should just pay you on your behalf. Right. So let's look at the other source of your income. Employees may be receiving other incomes from somewhere, and they are obviously included as part of their other income. Right. We know about those rooms that you have, Kokasi, there. When you're getting an incomes from those people, make sure that you include that. That's part of your other incomes. When we find out, we're going to issue this big letter to say that you owe us this much. Okay, so, but anyway, people have been getting away with murder when it comes to those small portions of incomes that they do receive from their other source. So it may not be rentals of rent, rooms, or the flat that you are actually owning. It may be that you've got a spaza shop, or you are actually selling healthcare products or beauty care products and all of those, or your ponytails and whatever that you actually may call it. Please just they just encourage you to actually can disclose. But IRP5 certificate. IRP5 certificate. How many of you have seen this or have had that? I'm back at your screen now. Who knows what the IRP5 is?
I check here, it says the employee tax certificate that is issued to them at the end of each tax year, detailing all employee-related incomes, deduction, and all the taxes.
That's 100% correct. So usually what happens is the employer will issue out what's called the employee certificate based on how much you've been paying for your tax throughout those months. All right, so that document has to be taken to SARS along with some other documents like your ID or your proof of address and the banking details. So they assess you based on that information. So that information is already on tax, on SARS tax system. So whatever that you see on your IRP5, they do have it on their side. It's just for validation when you do make submissions. All right. It's actually part of their process when you do make your submission. Unless if you are, you can even see that when you do your e-filing. The information that's appearing on your the certificate is actually there on what do you call it? On your e-filing system.
Oh, right? Okay.
Yes.
And then
so
what do they mean by the tax year? Is it annually or how do they count that tax year?
The tax year, I think, is because of maybe you came in late. So the tax year is usually what's called the fiscal year. All right. So what happened is actually treated the same as the year of assessment. If you remember what we did in accounting yesterday. So but tax, they call it the fiscal year or the tax year of assessment. It's very specific though. It's not like in accounting where you can just pick up any month, any date, and do your own financial record. So the starting period is usually the first of every year in March, and it's going to end on the 28th or the 29th of February every year.
Oh, okay. Thank you so much.
That's how it talks. It says. So I think SARS is actually opening for the submissions in June or July. So that's where you have to up until the date they say it's fine for them. Right. But the tax year of assessment is actually from the 1st of March up until the 28th or the 29th of February. That's a very good question, Jessica. At the end of each year, the employer must provide an employee with your IRP5 certificate to assist them in completing tax returns That's the whole idea of why they're giving you that, right? So people have got this idea that when you get an IRP5 from your employer, it means that SARS owes you money. It's highly possible that you can owe them, or it's even highly possible that you can break it. Right. Furthermore, the IRP5, it contains information regarding the employee. I told you about that. I think I didn't tell you about the employer's information, including the codes. Yes, the codes in terms of the incomes or the expenditures, they are there. I can't just remember which codes are they, but I think it is there in your study guide or look in your textbook. There should be a structure with regards to the IRP5 and how does it look like. Right. Further, with the employer informing including the codes of the source codes and financial details. Sample of the IRP5 is on page 36 of the titular letter. Okay, I'll put a date for you here. Page 36 of your tutorial letter 102, you will find a sample of your IRP5. All right, let's go further down. Tax and liable for the income tax. The taxpayer up to a certain age do not pay tax up to a certain amount, and we refer to those amounts as the tax threshold. Right, in tax, we've got this thing called rebates. Rebates, it deals with the age factors of the taxpayer. I think they start from maybe the early 20s up until maybe 35, and then it could, or 50 something, and then it continues up until 60 something, and then it continues from 70 something upwards. Okay, so you'll deal with that. I think I've got a questions that has something like that. It changes every year as the ministers makes an announcement. So when you look at page 37 of your study guide, it has the details on that category. All right, so if you are prepared for this class today, you should have an idea of what am I talking about. However, you will see that when you do that question. But my apologies for not detailing it enough. Registration as a taxpayer. Any person who earns a salary above the tax threshold must register for tax, and the registration can be done via the employer or the e-filing system on the SARS web, and the practitioners can also act on the behalf. Okay, there are two ways of doing this. Your employer usually, when I know with me, when I started doing my jobs, they gave me this form that has blue letter colors, and then you complete all of the details in there. And the employer will tell you to actually take it to SARS, or you can take it to HR or finance, and they would know how they're going to deal with that. Or sometimes we just say you can take it over to SARS yourself. So that will include your details with your new employer, including your bank details, everything that is required and necessary. Okay, so SARS also appoint what's called the practitioners. Practitioners meaning that you were given a license to act as a practitioner on behalf of people that they want to submit their returns. So usually we call them the tax practitioners, or they call them the tax specialist. All right. So if you are unsure about how you go about the submissions of that, they can handle that for you. Okay. So obviously they've got what's called the license number. It's like when you are a doctor or when you are a CA, you are given the license number to can perform the CA duties. Or if you're a doctor, HPCSA would give you a practice number, and just usually they write it when you go to the doctor's room, they write it Dr. Smith, practice number, whatever the number is, so that should there be anything that goes wrong, you can report your doctor to HPCSA and give them the proof with regards to your practice number. Right, or even when they made the yearly or the periodically payments for their renewal of that, they use that as probably their reference. Certain documents that are required for various employees, where they are from and their age as well. So that will include your address, okay, and your ID number will tell you what age you are at. Page 38 is the conditions of employee who must submit their tax return depending on the SARS terms. They've got terms and conditions on who must submit, how, why. Why? So if you go to page 38 in your study guide, it is actually there. You will find something that you can read on. Income tax returns. The taxpayers are required to submit their returns on a yearly basis by the ITR 12. I told you that, populated on the SARS web, generating the employer and the employee details. So this is how it goes. Usually SARS would just say, if you want to register via the e-filing, then they would want you to actually capture, create an account that has the username and the password. So every time when you go in there, you'll find all of your details that you are looking for. So even if you want to match all these figures that your employer gave you on the IRP5 and your figures on the SARS website, you will find them before you can do your submissions. Right, submissions can be done via the e-filing. That's when you were registered with SARS or branch, or by the tax practitioner. So you can actually get your documents in order, and then you go to SARS, they will do the submissions for you. I did it the last time, but I wasn't aware on how to use the e-filing. Documentation requires are also on page 39 of your study guide, but that's usually your IRP5. If you've got a medical aid, the medical certificate. If you've got investments, then they send you what's called the investment letter from your financial institution, and then you bring your ID certified and the original, the proof of address, along with your banking details. And that will be all. They will be able to assist you with what you are looking for. Income tax assessment process requires, I'm sorry, this thing doesn't look that much. The process required to be followed for the calculations of the tax returns are actually page on the page of the guide. Okay, but let me just give you a hint of this one because it's not clear. So when you submit your returns via the ITR12, immediately when you click on submission, the results would be issued with the IT834, right? So IT834 is actually the results that you get from SARS. So you got that, whether you are happy or you are actually unhappy. But remember with the learning unit 1 where we talk about the dispute resolutions. So if you're not happy about that, you can just look as to whether there are corrections to complete that kind of a form, and then SARS will be able to look at that. Obviously, there's a turnaround time with regards to that, and they will be able to give you feedback as to whether there's an error that has occurred when you made submissions. All right, but income tax assessment, they're just specifically speaking about the IT834. The income tax framework calculations is very important. Please have a look at the framework on page 42 of your study guide. It's very important because we're going to deal with it from now on up until end of our learning. All right. We have you further on. Medical tax credits. I'm just going to give you the theory. There's no questions that is going to be based on this. But the medical tax credit deals with the individuals that belongs to a medical aid. I gave an example with MAD or Discovery for the contributions to be paid and be deducted from the medical tax credits, and they form part of their rebates deducted from the normal tax payables. Age and disability have a major impact on your medical tax credits. You will see that when we are dealing with that on Saturday. So you need to consider this. Please go home and read your medical aid tax, and then make sure that you do a little bit of calculations. I want to see questions. I want to see questions when we meet on Saturday. Right, and in order for you to actually make the payment of the medical aid, you need to belong to a medical aid firm. And like I said before, sometimes your employer, they pay a certain percentage on your behalf, and then you pay. That's one of the things that we will be dealing with when we meet on Saturday. But excuse me for a minute. Right, I'm back. Types of medical tax credits. We've got the medical scheme tax credits. Right. Hold on for me. It is a non-refundable tax rebate which reduces the normal tax a person's pay, or any portion exceeding the normal tax payment not allowed in the current year must be carried forward to the next financial assistance. So if there's a rebate or there's a credit due to you, you're not going to get that money. It's going to be carried forward through to the next financial period. So additional medical tax expense credit, tax credit, additional medical expense tax credit. Sorry. It is also a non-refundable, and it is based on reducing the normal tax that a person's pay. A portion that is not allowed in the current year can be carried forward towards the next year of assessments. It is calculated against the qualifying medical expenses paid out of pocket, expenses paid by the taxpayer and their dependents and given as an additional scheme, tax-free. Sometimes you don't use your medical aid to buy medication over the counter. You use cash, and then you can claim it back from your employer, or sorry, from your medical aid company. So they will tell you documentation that they need in order for them to actually pay you that amount of money, because you paid that out of your pocket. So page 47 is a list of the defined spouse list and the disability. So we are actually going to convey on that one when we read on Saturday. Let's look at the qualifying criteria formula. A person who is 65 years of age and had a, my apologies for that, grade, okay, I'm not sure which grade is that, but if you are 65 years of age, so the formula to be in use is 33.3% multiplied by A minus, open brackets, 3 multiplied by B into the brackets plus C. So we're still going to define what that A, B, and C is, all right? Because that's going to be very important, especially if you're dealing with that kind of qualifying criteria for medical aid formula. What a spouse and a person or a child with a disability, it's actually different to the one above. It says 33.3% multiplied by A, that's in the open brackets, minus 3 multiplied by B plus C. So basically, if you can look at the two, there is no difference. It says that all other persons who do not qualify for the above category, it's going to be 25%, open brackets, A minus into 4 times B plus C minus into 7.5% multiplied by D. Please do not be intimidated by all of these multiplications and the letters and the percentages. They're clearly going to be defined when I deal with you on Saturday. I'm just giving you a hint now. All right, so I've got a little bit of information here. A represent the fees paid to a medical scheme fund for the year of assessment. And then the B is called MTC for the year. I think they will give you that. If we have to calculate that, it means that we have to arrive at the figure for that. C, all qualifying medical expenses paid during the year of assessment. And D is your taxable income, excluding the retirement lump sum benefit or withdrawal benefit and the severance benefit. Okay, that brings us to the end of our learning unit 2. I think we'll be left with the question. I would like everybody to go on page 22 of your study guide, because we're going to need those text brackets to do this question. Please go to page 22 and let me know if you got it. Okay, it says that the question is actually based on the normal tax calculations. And question number 1, it says that putting Meso's taxable income for the current year of assessments amount to 121. Anybody with an idea on how you're going to approach this question? I'm going to give you the solution based on this question. Anybody quickly? How are you going to calculate the normal tax for this? Okay, no problem. The first thing that, because you guys were not prepared for this, the first thing that you do is you're going to look at the table, and then we are going to match the income that we have. Okay, so the table there, it has on the other column we've got the table content with the amount, and then we've got the table content with the tax rates. All right. So what's going to happen now is, I hope you guys are actually on that page itself. We're going to look at how much is the taxable income for Mr. Meso, and then we're going to go to the table, and then on the table we're going to pick up the tax brackets that is actually suitable for that one. Line item number 1, it says that taxable income from R1 to an amount of 205,900 Rand. It's applicable for 18%. And line 2, it says 205,901, 2321,600. It's 37,062 plus 26% of the taxable income above 205. And line 3 says 321,601 to 445,100. So the applicable rate is 67,144 plus 31% of taxable income above 321,600 Rands. Number 4, it says 445,101 to 584,200. And the applicable tax rate says 105,429 plus 36% of taxable income above 45,100. Number 5 says 584,201 to 744,800. And the applicable rate is 155,505 plus 39% of taxable income above 584,200. Right, the second last says 744,801 to 1,577,300, and the applicable tax rate is 218,139 plus 41% of the taxable income above 744,800 rands. The last one says from 157,7301 and above, and the applicable tax rate says 559,464 plus 45% of the taxable income above 1,577,300. Okay, so in regards to our first question, it says Putimeso's taxable income for the current year is, the current year of assessment is 121,000. So this is what you're going to do. It matches line item number 1 on the taxable income bracket. You just say 121,000, then you multiply that by 18%. Ask somebody with a calculator to assist me there. Kindly, please. Percentage on my desktop. Okay, it's 18%. But hello, can you hear me?
Yes, it's 21,780.
Is it 21,000?
708.
708.
Yes.
Like this.
708. 780.
780.
Yes.
Right, and then we're moving on to number 2. Is everybody clear on this one? If everybody's happy, we're just going to move on to the next one. It says, what is the normal tax for of Putimeso if the taxable income is 235,000? 235,000. How do you calculate that? Look at the tax brackets. Don't be scared of looking at it. Okay, so this is how you're going to approach this question. You would say, in answering that, you would say 37,062, and then you plus it in and open the brackets. Follow me, please. The answer would be 37,000. My apologies. Let me just go through the brackets. It's 37,062. 37,062, and then you say plus, and then you open your brackets. So you open the brackets. You go again to your tax brackets. It's actually line number 2, so I didn't mention that. So you'd say the taxable income itself is how much is 201. Okay, taxable income is 235,000 rands, and then you minus all that last figure 205,900. Can you see on how you guys do it? 205,900, and then you close your brackets, and then obviously we're going to look at the percentage to be followed on, and then you close the brackets and then you multiply that by 26%. That's the applicable rate on that one. So you'd say multiply, as we close the brackets, and then you'll say multiply 26%. Where's my percentage now? Percent, and then you close the brackets. Right, obviously you're going to follow the steps. 37,062, and then you plus into how much is 235,500 minus 205,90? I think here I'm supposed to say 235,000 and 205,900. Let me just verify that, please. Is it 205,900? I'm correct. So how much is 235 minus 205,900?
29,100.
99,000. Can you just remove the brackets and say 99,000?
21,900.
Is it 21900?
29100. Yes.
29100.
Yes.
So, and then you're still going to say multiply by 26%. So how much is 37062 plus 29100?
It's 66,152.
Please give it to me.
66,162.
66,100.
62.
152.
162.
162.
Yes.
All right. And then you're just going to multiply this by 26%. How much is it?
17,000.
17.
202.
202.
12.
And 12. That's your final answer. That means E is the normal check.
Can I please ask something?
Please come again.
Can I ask something?
All right, you can go ahead. Let me just go to Teams and check who is this. Just a moment.
On our table on the study guide,
Yes.
I think we're using the different amounts because on our second one it's 38,916 plus 26%, not 37,062.
Is it 3? Okay, which amount did I use?
Sorry?
Which amount? 37062.
Yes, on the 37062. On our study guide is 38,906.
Okay, sorry, who is this? I beg your pardon?
Sorry, can you hear me?
I'm struggling to hear you.
Okay, let me shift a little bit. Can you hear me now?
Yeah, it's much better now.
Sorry?
It's much better now.
Okay. On the table that we're referring to.
The table, okay. Yes.
On the second one, I think the first one is 18% of taxable income.
Correct.
On the second one, on our table, it's 38,916 plus 26% on the rate of taxes. It's not 37.
Oh, it's not 37.
Yes.
Okay. Let me just have a look at that. Sorry about that. Oh no. So it's actually 37,062.
It's 38,960.
Okay, and tell me, where do you see that?
Okay, on the page 21 on our tutorial letter 102, the one that we downloaded on the online.
Oh, you know what? Sorry about that because I think I'm using the last year one. My apologies for that. I think they made adjustments. Okay, let me. Okay, don't delete that. I think we're gonna use yours. It's fine. Sorry about that. My apologies. Okay. I'm using the old one. Okay, let's start all over. You said it's 38.
960.
96.
916.
916. Okay, so that means it's going to be a huge adjustment to be made. So it's going to be 38,916. Okay, how much is 38,916 plus 29,100?
38,916 plus 29,100. It's 68,016 rand.
68016, right?
Mm.
All right, and how much is that multiplied by 26%?
It's 17,000. Okay, excuse me.
Sorry, 17,000.
Let me do it again.
Okay.
It's 17,684.
674.
684.
684.
Yes, 16 cents.
16.
Yes.
Okay, thank you very much for that. Let's look at number 3. So 17,684 and 16 cents is actually our final answer in terms of the normal tax to be payable. All right, so what is the normal tax of Punti if taxable income is 1890? On the table, what do you see? You just have to advise me of the figures because I'm using the old one.
I think we're going to go on the last one, which is taxable income is 1,656,601 and above.
Okay. Give me what is it, the process? Like what did we do it in the previous one? Which amount am I putting first?
You're gonna put 587,000.
587.
593.
593.
Yes.
Plus open brackets.
45 oh, sorry. It's 1,890,000.
Okay, this one I have, it's fine. And then you minus.
So we are minusing this amount which it says of the above amount on the rate of tax.
So how much is the amount?
It's 1,656,000.
16. Give me the numbers. 16.
1656.
56.
600.
600.
Yes.
I'm closing the bracket, then I'll multiply that by, what's the rate? 45.
Yes, it's 45%.
45%. Okay. So how much is 189,000,000 minus 165,660,000?
It's 233,400.
So I didn't get you there, my dear.
233,400.
233,400. 233,400.
Yes.
Right, and then you multiply that by 45%. So how much is 233,400 plus 587,593?
It's 820,000.
820.
993.
993. And then you multiply that by 45%, right?
Yes.
So how much is 820,993 multiplied by 45%?
369.
369.
446.
446.
85.
85. Okay, that will be your final answer. Not bad, right? Not bad at all. I'm sure you would agree with me on that one.
Yes, I agree.
So the calculations of the normal tax is actually not that bad, right?
Yeah, it's straightforward.
But it's a straightforward one, right? Okay, before I go on the last question, who is struggling with that? Who need assistance on that? Who want me to repeat it? Who wants me to repeat it?
Hello.
Hello.
How are you?
I'm fine. How are you?
I'm blessed, thanks. I joined the class late. Can you please repeat it? And I'm
Okay.
sorry for joining late.
Oh, no problem. Who is this?
Sorry, Simas, look.
Okay, let's see. We go to Teams. It's Takani Masuluke.
Yes.
Okay, no problem. All right, what we did here is we were looking for the calculations of the normal tax, right? So in order for you to calculate the normal tax, you need to get to the table. I think it's actually on page 20 something in your study guide. So let's have a look at what the question says. The first question says that calculate the taxable income for the current year of, actually not calculating the normal tax, we are calculating the taxable income. My apologies for that. For, sorry, the normal tax, I'm correct. So you're given the taxable income for the current year of assessment with an amount of 121,000. I'm sure you can see that, right?
Yes.
What we do when we have this kind of a question is we need to go to the table and we're going to match the line item that matches 121,000 rand. And the adjustment is going to be made in accordance with that line item specifically. So in the first one, when you go to the text tables in the study guide, okay, hold on for me. All right, somebody was helping me there. Can you just tell her where the table is in the study guide? Page 20.
I won't be able to see the on the thing because I'm using the phone for Microsoft. So I did write the notes on the notebook.
I see.
So I will
refer.
Yes.
All right, I see. All right.
It's page 21.
Page 21, my sister.
I will check afterwards.
Yeah, if you go to page 21 of the study guide, unfortunately, I don't have the same rebates as you or the same rates as you. But if you go to the page 21 of the current year content, you're going to have the exact amount, the correct amounts. So, but in regards to the first question, it was meant to be on the first column, where it says taxable income with the rent. It ranges from 1 to 205,900 rand. Okay. And then the taxable income is 18%. So what you do is you take that amount, I think it's 200 and something rands, and then you multiply that exactly by 18%.
Okay.
Right. Am I making sense?
Yes.
Okay. So on the second one, we're given a different amount in terms of the taxable income, but we found line 2 matching that, where it says the range is from 205,901 to 321. Applicable tax rate is 36,062. I'm giving you the incorrect amount because it's different to yours. Plus 26% multiplied by the taxable income above 205. But this is how you're going to approach this kind of a question. You're going to take the taxable amount and then you're going to minus the last amount on that applicable tax rate. You'd say 200 and whatever the amount, and then you minus 205,900. That's actually what's on my side. And then you plus it with 37,062 on your side. It's going to be a different amount. I think it's 38,000 something. And then after plussing that, you multiply that by 26% and you get your final answer.
Okay.
Yeah, but if you need more clarity on this one, send me an email. I can send you what we did in the class today so that you can refresh on it.
Okay, I'll do so.
All right. Okay, my email is paladi@gmail.com, and my cell, which is on WhatsApp, at 067-859-3121. Let me know if you got that. I just tapped it here on our page solution.
Okay, thank you. I got it.
Thank you very much. Whenever you need something, you can just send me an email on that one. And then make sure that you send me a WhatsApp as well so that I can create the WhatsApp group specifically for tax. Because for now, we've got the accounting WhatsApp group.